A big part of my job is traveling all around New Zealand, really, to meet with groups such as yourselves and give presentations, which I do occasionally in Queenstown and elsewhere. And again, that's off the cards. So we're all learning to work from home and to give presentations by video, and it's kind of an interesting learning experience that we're having, and I think we're all just sort of being a bit more forgiving with how things are working. So let's see what we can do for the next wee while. Yeah, I'll talk for about half an hour and then we'll open it up for questions. And as Anna mentions, I'll talk mainly about the New Zealand-wide effect of COVID-19, but we'll drill into Queenstown-specific bits if we can. So I think everybody appreciates the depth of the downturn that the New Zealand economy is going into. What all of the economists have done is sort of go through, okay, at level 4, level 3, and level 2, what is the effect on all of the 100+ industries that the economy can be divided into, and you tot it up for an overall economic impact. I'm actually a little less pessimistic than the Treasury and Reserve Bank when I do that exercise. I think at level 4, about 1/3 of all economic activity was unable to happen. At level 3, it was about 13%. And at level 2, actually, by far the biggest direct impacts is just the closure of the border, lack of domestic travel, and the lack of ability to congregate as more than 100 people. So things like sports events or concerts not being able to go ahead. And that's worth about 4 to 5% of GDP. I mean, when you talk about only 4 to 5%, it's a pretty incredible thing to be saying. The entire global financial crisis involved a GDP decline at its peak of 2.7%. So this is just massively bigger. So what I'm expecting to happen is obviously about a 17% drop in GDP over the first half of this year, about a 13% rebound in the September quarter, just as people are allowed out. But that will still leave the economy smaller than it was before we went into the downturn, quite a bit smaller. And I think while there will be a sudden resurgence of activity, just as people are allowed out and perhaps they haven't been spending for a while, there'll be some catch-up spending, but it won't last long. I really think that the impact of the downturn is going to cast quite a long shadow over the economy, and that will make growth quite hard to come by in late 2020 and early 2021. So basically, I mean, again, my estimates are less pessimistic than others, and I still think the unemployment rate will peak at 9.5%. Unemployed people don't spend as much. And people who fear for their job don't spend as much either. And so as businesses come out of the lockdowns, what they will actually find is that spending has been, they're emerging into a recessionary world where household spending is down. Businesses may have had to borrow to get through the downturn. So they're not going to be very interested in expansion or investment or employment. And again, that will have its own effect on demand in the economy. There'll be a global downturn, a global recession going on. I mean, people are talking about this bubble with Australia and all the rest of it, but you've got to remember Australia will be in the depths of a really big recession. So I'm not convinced they're going to be all that keen to fly to New Zealand and ski, for example. And where I've thought more about this is the farm sector will sort of face into a global recession, and we'll find that global food prices drop away just as global oil prices have recently, again, as consumers take some time to recover. So what I'm saying is, I mean, there's an initial downturn and a recovery, and that's all pretty simple. They're big, spectacular numbers, but it's pretty simple. The thing to bear in mind is the shadow that period of unemployment will cast over the economy as we go into a more classic balance sheet recession type environment where people are more interested in repairing their balance sheets than they are in spending. And that creates a more classic slow economy type environment. That said, recessions, at about this point in recessions, typically in places other than Queenstown, where I actually find in Queenstown people are perennially sort of very chipper and upbeat, which is great. And everywhere else in New Zealand, people tend to have quite long faces. You get into a recession and they extrapolate and think it's going to last forever. And it never does. There's always a recovery, and it's often a period of really quite vigorous growth in the recovery. And the recoveries are generated by by low interest rates, government spending, sort of stimulus out of the official sector. Eventually, balance sheets get repaired. So what I mean by that is asset prices stop falling, they turn around, people start to feel confident to spend, and you get a recovery phase. And often that recovery phase involves quite rapid growth. I actually think this time that recovery phase will be earlier and much more vigorous than it was after the global financial crisis. There's actually good evidence to back that view. Basically, downturns that involve banking crises are shown to last longer than other downturns, and there hasn't been a banking crisis this time. And secondly, it's just the more obvious point that what's happened here is a disruption to economic activity. That while it will have permanent effects, it won't have permanent effects for the whole economy. So eventually, COVID-19 will pass, lockdowns will cease, and that is an obvious catalyst for the slow process of recovery to begin. So again, big downturn. I think a really slow period is we're in a classic balance sheet recession. Earlier and more vigorous recovery than you saw after the global financial crisis. And in the last phase, unfortunately, I don't think New Zealand will ever quite reattain the trend that it was at prior to COVID-19. Let me just show you what I mean on my screen here. So I'm assuming everyone can see that. Dotted line is our pre-COVID forecast. The red one is what we're expecting now. You can see this big drop, big recovery, period of slow growth, period of vigorous growth, late 21 and into 22 kind of thing. But we're never quite reattaining. We're permanently worse off because of COVID-19. And that's, I think our productivity and well-being will be permanently affected by this thing. Basically, when people are unemployed, their skills atrophy and their productivity diminishes. When businesses fold, good ideas that they might otherwise have had fail to be spread around the economy. Entrepreneurs will find it harder to get the money they need to spread their brilliant ideas. Firms will not invest in productivity enhancing research and development or even other forms of investment while they're trying to repair their balance sheets. Actually, closing the borders will have interesting effects on productivity. Good ideas will find it harder to spread around the world. Bad companies will find it easier to continue to thrive in countries that are more separated from other countries. And there'll be worse job matching. I think this is really important. So Kiwi firms will have to restrict themselves more or less to Kiwi employees who aren't necessarily always the best employee for the job. Equally, talented Kiwis will be unable to go overseas and get the best job for developing their skills. They'll have to settle for a lesser job within New Zealand, perhaps, than they otherwise might have. And so the match between employer and employee won't be as good as it otherwise could have been. And all of these things will have, unfortunately, a long-run impact, preventing the economy from ever sort of reattaining that previous level. In terms of, I've already mentioned unemployment. So if I just share my screen again, I've mentioned unemployment. I think that's going up to 9.5%. You can see that compared to the early 1990s recession, that's not quite as bad as it got then, but you can see the recovery is it's still 4 years before we get below 5%, but it's much faster than past recessions. I think a lot of business people are really interested in, okay, we get that the post-COVID world's going to be kind of flat for a while. There will be a recovery, but what sectoral effects is it going to have on the economy? Which sectors are going to impact worse? What's going to have changed permanently? And I think in Queenstown, you all understand that closing the borders is going to mean a real lack of international tourism for quite some time. I'll come back to that. I think the general way, the best way to think about the permanent effects, how do you plan for the post-COVID world? I think the most important principle to bear in mind is that disruptive events like this tend to exacerbate trends that were already underway. So we really learnt this after the earthquakes. Lots of people told me that Christchurch was going to disappear, and I said, no, there's a reason to have a city there. But the city had been moving from east to west for years, and that trend probably, you had a couple decades of it all at once. I think in all sorts of ways, trends that were already in place, you tend to get a shake up to the economy, and you get an acceleration of trends that were already in place. We've seen, say, a taxi company going under in Wellington was one of the first examples. They've been under pressure for ages, so this was the last straw. I think the most obvious example of a trend that's already in place and has been accelerated by COVID-19 is digitization of the economy. So it's been happening for years, decades, but it feels like we've had 5, 10, 15 years all at once. Sort of technophobes like me have learned to work from home and to use technology like this. People have had to get online to make their business survive or just go by the wayside. Businesses or business models that are not well adapted to the digital revolution that's been going on for a long time may well find that this is the last straw, and they may well finally pass due to this event. Other businesses that have been growth models sort of waiting to happen and just sort of slowly growing will really get a leg up from the digitization of the economy. And it's amazing how commerce has found interesting ways of going online where it can, although we're all looking pretty shaggy, no one's figured out how to give a haircut online. When you think about digitization, so there's going to be a sudden leap in digitization. That creates a winner-takes-all economy. In many cases, unfortunately, what that's going to mean is more revenue going to San Francisco. However, it also creates opportunities for New Zealand firms to become the winner that took all and to become the global champion in their niche. So I really think we could see opportunities for that. And of course, digitization does get rid of the tyranny of distance a little bit that New Zealand has long suffered from. The other thing that might change permanently, or the other possible permanent change from COVID-19 is change to supply chains. So a lot of people are looking to their suppliers and thinking, oh, well, it's a bit of a shock that borders closed. I can't necessarily rely on this supply chain coming from China. How am I going to do business now? Maybe I need to rethink it. And I know that business people are actively rethinking supply chains right now. I actually think this is going to play out quite differently for different parts of the economy. I think there could well be local firms, people outsourcing to overseas less. There could well be more local manufacturing or production, for example. That's actually a trend that's already been in place for a while. Basically, 3D printing has been emerging for some time. It allows more bespoke, just-in-time, locally based manufacturing. And you could well find that people's fright with supply chains sort of exacerbates that trend now, and you get more high-tech manufacturing, creating this just-in-time environment sort of emerging in New Zealand. However, I actually think people who are supplying basic consumer goods, I know I've talked to them and they are telling me that they're all looking at changing their supply chains. My prediction is that won't last. And the reason is basic consumer goods compete on price. So the firm that sticks to the non-pandemic proof but cheap supply chain will drive their competitors out of business between pandemics. The one that goes for the pandemic proof supply chain will be well set up for the next pandemic, which could be 100 years away. So I actually don't think that basic supply chains and basic consumer goods will change much. Lastly, really, what I'm saying there is the market will continue to speak and keep things cheap unless governments get involved. And I think around the world, there could well be governments that leap in and use this as an excuse for protectionism. People are using this as an excuse for pushing all sorts of barrows that they've got, actually, left, right, and centre. Everyone's jumping in to try to push the barrow that they've long had. And protectionism probably was on the rise around the world already. The days globalization peaked a wee while ago and was probably already in retreat. And I think that could get a real leg up. And unfortunately, that does mean New Zealand's export sectors, farm sector, could well struggle a little bit in a more protectionist world. Could also mean that if New Zealand goes down that path a little, some local businesses that have been struggling with international competition could get a reprieve. I actually think the wood manufacturers are an example there. They could well have a reprieve from this. Just in terms of industry sectors, I mean, I tend to find that people in the industries know better. I mean, I can talk to you my views on tourism. I'm sure you've got fantastic views coming through to Queenstown in general. I will show you a chart because I think it's pretty spectacular. So we had, this is the number of international visitor arrivals to New Zealand, monthly, seasonally adjusted. You can see, Asia crisis. It was a terrible time for tourism, but it looks like a blip these days. Christchurch earthquakes, Rugby World Cup. These are tiny compared to COVID-19. We had 3.9 million visitors annually in 2019. We're looking at, way under 1 million in 2020, probably under 1.5 million in 2021. And I think it'll be only a gradual recovery. This takes you out to the end of 2021, by the way. I think the first step back, of course, will be domestic tourism, actually. So that's not really on this chart. And again, there will be that. There'll be offsetting factors for domestic tourism. Kiwis won't be able to travel overseas, so they'll have to travel at home instead. And Queenstown could well benefit from that. However, Kiwis are going to, 10% of them will be unemployed. The other 90% will have seen their KiwiSaver balances eroded. They'll fear for their jobs. They'll fear for their businesses. And in general, this year's not the year they're going to be taking a holiday. I actually think the positive will outweigh the negative on that. But I think you do have to remember that there is two sides. Same thing applies really with the Australia bubble, if we do form that with them. My pick for the third group back is young people. Because young people are less fearful of COVID-19, either because they suffer from the disease less or they're just more foolhardy because that's who they are. But either way, I think young people will be next in. They'll be traveling around the world more. And I did have this idea, for anyone who follows my work, I did have this idea of immunity passports, and that people who had already had the disease or had been immunised early would be the fourth group, sort of back into tourism. Apparently it's a little uncertain, depends on what the World Health Organization says about immunity if you've already had the disease. So I'll leave that up to the epidemiologists. But if that does come to pass, I think it'll mean Europeans and North Americans first, because they've got the disease worst now, so they'll be the first immune if it kind of ends up working that way. Within tourism, and actually in the wider economy in general, there's a bit of a difference between how small firms and big firms are going to behave. And how the sectors populated by small firms will evolve. So I'm thinking small firms, little tour guide type firms or cafes, that sort of thing, they don't have deep pockets. So a period of no revenue could well send them to the wall. And you could well see many more bankruptcies in those industries. However, there are low barriers to entry in those industries, and that is why they're populated by small firms. And that means when tourism slowly starts recovering, and by the way, I do think it will eventually get back to normal, just like it did after the 1918 influenza pandemic. So it's not like travel and trade stopped growing after that. It's just going to take some time. When it does eventually recover, actually the industries populated by small firms will be more dynamic, because that's where the growth will be. Industries populated by big firms, so the big car rental companies, the hotel chains, petrol retailing, that sort of thing. They've got deep pockets. They're probably more likely to get the support of their bank or the government, so they'll probably survive. But they'll have to take on lots of debt to do that. And on the way out, they'll be less dynamic and less interested in investing and less innovative, because they'll just be focused on getting debt down. And that's okay. You'll have these sort of legacy, I won't call them zombie firms, but you'll have these firms weighed down by debt populating these industries. But there's high barriers to entry to those industries, so it's less likely that they'll be disrupted. So I think there'll be quite a difference between how small firms and big firms behave. Last industry comment is construction. The construction industry is going to have a big flurry as projects that were already funded and underway get continued. But basically, during recessions, construction slows, and this will be no exception. So there'll be a big slowdown in construction beyond the first few months after the return to level 2. It'll last a couple of years. Construction is the most volatile industry really out there. It'll turn down, and I know it's a big part of the Queenstown economy actually, so it'll turn down, unfortunately, in Queenstown for quite some time. Thing is about Queenstown, when it gets going again, I really notice that it really gets going. But yeah, no, I think it'll compound the hard times that are probably ahead for the region, because I do notice when times are hard, Queenstown does tend to be hit quite hard. On that note, the housing market. So during recessions, house prices tend to fall. I'll show you another chart on that. These are house price downturns. Everything's indexed to 100, nationwide house prices in different recessions. So you had about a 3 or 4% decline in the early 90s. You had about a 10% decline after the global financial crisis. I'm picking about a 7% decline for COVID-19, so somewhere between the two. That's because the GFC really was about house prices. That was what actually caused the GFC. That was kind of the main cause of the event. I don't think it's going to be that bad for house prices this time, but it could be faster, just as vigorous. But again, I think an earlier and more rapid recovery. So I'm picking negative 7% nationwide for the second half of this year, basically flat in 2021, and actually positive 11% for 2022 is my forecast for house prices. Reason for that is we're going to come out into very, very low interest rates. And as I said, low interest rates and government stimulus is what tends to drive recoveries. Then it tends to create this recovery in asset prices back to what they're really worth after the fire sales are over. And that tends to create a bit of confidence and get the ball sort of rolling. And I think that process will be underway in 2022, but rising house prices will be a really important part of it. People often ask me about regional house prices. They often claim that Auckland has more volatile house prices than other places. That's not supported by the data. The truth of the data is that Auckland and Wellington prices fall really fast after recessions. The whole rest of New Zealand falls much more slowly, but just as far. So, it takes years for smaller regions to experience lots of house price decline. But it does happen. It's as big, or if not bigger, than the declines you see in Auckland and Wellington. Unfortunately, if I had to pick one region for a greater than 7% decline, it is Queenstown Lakes region. It's just that the exposure to tourism, I know it is a region that is a little bit up and down. The exposure to tourism it really does sort of single that region out. Probably Rotorua might be another one. There's a few other, West Coast actually, as well. There's a few other regions, but I do think, if I have to look around New Zealand and pick a region that's likely to experience more than 7% house price decline, it is Queenstown. The journalist from your local real estate industry who rang me on Thursday was most unimpressed when I said that, but that's the view. The other thing is actually, one of the more volatile parts of the housing market is the top end. The very top end tends to experience bigger percentage declines during the big ups and downs in the economy. And Queenstown is one of the places that has very top end properties. Okay, so I'm sorry for the bad news there. Maybe I'll reiterate some of the good news just to balance things up a little bit. Very, very, very low interest rates coming out of this will drive asset prices higher in time. And I absolutely am of the view that asset prices are experiencing fire sales at the moment. So they're trading for less than they're really worth. I'm not really a share market guru, but I really just did not understand why people thought that, say, an electricity company was worth 40% less than it was previously. This is a 50-year asset, and we're talking a 2 to 5 year event. So fire sales and asset prices, I do think there'll be a recovery aided by very, very low interest rates. Now, just in my last 5 minutes talking before I open for questions, I want to talk about the government and Reserve Bank response. The government's job in the near term is just to support the economy through. A lot of businesses have got zero revenue. Cash is king. If they don't have cash flow, they'll fold. And that, in some cases, unfortunately, there's a new world and they just are going to fold. In other cases, it's just wasteful to let them go under during a temporary period of zero revenue. And government knows that. They don't want to separate employees from employer and lose that firm-specific capital. They don't want perfectly good firms to fold and then have to go through the process of somebody else taking that niche in the market. It would take ages. So I think the wage subsidy scheme has been, I know that it hasn't been enough for a lot of people. They would have liked more. people always sort of want more, but it's $10 billion. It's a heck of a lot. And I think it's done quite a bit to prevent, some firms from folding and especially to keep employees attached to the firms where possible. So I think that's been a raving success. It really sets us apart from the likes of the US, where millions of unemployed people are emerging every week. The loan scheme, less successful. It seems like the banks are basically extending credit to businesses where they're viable, and the government's loan scheme there was not really needed. I think what you're going to see next at Thursday's budget is a massive expansion of this fiscal stimulus as the government looks to create an infrastructure plan, and it may well dole out money in a targeted way to people to try to to stimulate the economy to grow again. The consequence is it's going to push debt to GDP to 50%. And what that means is that in the future, right when the aging population was always going to put a lot of pressure on our fiscal books, actually, and people have been conveniently forgetting about that for the past couple of years, we're going to have 50% debt to GDP instead of 20. And that means fewer options you're going to have to either increase taxes or decrease spending down the line. And that means fewer opportunities for the economy to develop down the line. My pick for the taxes, probably, it might be the crisis we need to get a wealth tax across the line of some kind, or environmental taxes. I wouldn't favour increased income taxes. They're quite distortionary, and New Zealand already relies too heavily on income taxes, and all economists agree on that. Okay, 50% debt to GDP, that's a bit scary. Actually, the government is borrowing hand over fist, and if there's actually a bit of a risk that we could get a ratings downgrade, or markets might decide they don't want to fund the government. And what that would do, the interest rate on government debt would start to rise, and then private sector interest rates would also start to rise. So the Reserve Bank has taken the action it needs to try to prevent that from happening. They have started their quantitative easing program. So they're buying government bonds. And they're buying masses of them. They've already promised to buy 30 billion of government bonds. I think they, on Wednesday, when they release their monetary policy statement, they will expand that to 60 billion. And they'll own about half the government bonds on issue if they do purchase 60 billion. People get terribly upset by quantitative easing. I tend to find there are two groups. There are groups who remember banana republics of the 60s and 70s in New Zealand, and they think printing money, that's just going to create inflation. And there are actually other groups who, perhaps a bit closer to financial markets, who think, well, the US and Europe and Japan have been printing money for years, and they've still got low inflation, so it must be that it doesn't work. Both are wrong. Both are flat wrong. Printing money or quantitative easing or buying government bonds in exchange for cash always does boost inflation relative to what you would get if you didn't use it. If we don't use quantitative easing now, we will get deflation like we did in the Great Depression. New Zealand averaged an inflation rate of -7% from 1930 to 1933. I think in Europe, United States, and Japan, quantitative easing did work. That's why they've got low positive inflation instead of massively negative inflation. So New Zealand's quantitative easing, great idea. It does work, does boost inflation. It'll stop us from going negative, basically. Actually, my analysis suggests that even the 60 billion won't quite be enough, and inflation risks dropping really low. And that would be disastrous, because it means the debts people have built up don't get inflated away over time. If you slip into deflation, actually the real value of those debts grows bigger. So I think the Reserve Bank needs even more monetary stimulus to meet its inflation target of 2% per annum. So my view is we'll have a negative OCR. I'm forecasting it for November this year. We'll see what the Reserve Bank says on Wednesday. I don't think they won't encourage the idea of a negative OCR now, but based on what they say on Wednesday, I'll sort of get a better idea of the timing. Could be end of this year, could be start of next. We'll see. The only reason they didn't do it already is that the trading bank's systems are not ready to cope with a negative OCR. They need to upgrade their computer systems, and they need to update some legal documentation. So the Reserve Bank needs to give the trading banks time to do that, and that's the main uncertainty. I get lots of people sort of debating with me about whether negative interest rates are a good idea. I tend to find that I get an avalanche of that. The thing is, those objections are sort of water off a duck's back. The Reserve Bank has looked into it, assessed the international evidence. Late last year, they came out with a document detailing what they would do if the OCR gets to zero, and said that a negative OCR is their most preferred plan. So they are going down this track. They just need to give the banks time to prepare. And again, that could be quite some time, so it might not be till next year. Now, what does this mean for ordinary sort of firms, people on the street? Not much. The official cash rate is an interest rate paid by the Reserve Bank to the balances that trading banks hold at the Reserve Bank. It is quite a technical thing. It doesn't have a lot of relevance at all, other than being front page news and kind of upsetting people. I do not expect any retail or business interest rates at all to go negative. They have not gone negative anywhere overseas. Some people have seen news about a Danish bank that had a negative mortgage rate. Actually, the fee, it's like your interest-free credit that you get down at a retail shop. The fees were more than a normal interest rate would have been. So it was a swizz. You don't get negative rates for retail or for businesses. It just doesn't happen. So basically, the cut from the OCR of 0.25 down to negative 0.5, it'll bring mortgage rates and term deposit rates down a bit. Actually, it won't bring them down by 75 basis points at all. Technical reasons for that, but it'll have an effect. It'll bring them down a bit, and it's like an OCR cut like any other, and there's no need to sort of get terribly upset by it. So, and I'm not suggesting anybody on this line is terribly upset. I've just found quite a few people coming back to me and sort of arguing a lot about the negative interest rates. Lastly, exchange rates. So basically, the Kiwi dollar is a risk instrument in markets. It's been trading in lockstep with share prices in recent times. It fell to a really low level when share markets were at their gloomiest. It's recovered along with share markets. I do think that while we're sort of in COVID-19, while we're doing this quantitative easing, we're talking about negative interest rates, that'll keep the Kiwi low versus the US. Later this year, I think attention will start to turn to how successful have you been with coping with COVID-19? What's your fiscal stimulus like? How does your country actually have dealing with this relative to other countries? And I think at that point, New Zealand's done pretty well, and I expect to see us actually climbing against the US dollar, but only into kind of the low to mid 60s. Vis-a-vis the Aussie, I actually think we've dropped quite a lot in the last couple of weeks, and I think we could continue to drop. I think that when we come out of this, New Zealand relies heavily on tourism, and that'll take some time to recover. We also rely on food exports, and people often say, people got to eat, but you don't have to eat fancy imported top quality New Zealand food. You can actually downgrade to rice and grains. And that's what happens during periods of global recession. So I think our food exports basket is going to see our exporters take more of a hit than Australia's exporters, because around the world, there'll be all these government funded plans for infrastructure type stimulus, which will use loads of iron ore and coal. So I actually expect we could drop relative to the Aussie later in the year, even if we are sort of one of the world's higher performing currencies and rising vis-a-vis the US. Okay, so I think I've covered all the areas that I needed to cover in 33 minutes, not too bad. And I'm happy to open up for questions. I think Anna's going to sort of verbally give the questions to me.
Yeah, I am. Thank you very much, Dominic. So there's so many points you've raised there that were interesting. I was really interested in that the job matching scenario and how we've restricted our labour market to New Zealanders, and New Zealanders are restricted to New Zealand for the next little while. I hadn't thought about that. That seems like a particularly sad and significant outcome for some, I guess, and a great opportunity for others. One of the things that we're struggling with here in Queenstown is our ability to get data that's relevant to our region, because we are so critically impacted, and a lot of the aggregated data that's coming out nationally isn't particularly helpful or relevant to us. And certainly some of those numbers you said around level 4 and level 3 and the ability for businesses to be able to keep trading. We've done our own chamber research and compared that to Auckland, where 45% of our businesses here were unable to trade, compared to 13% in Auckland. And so it's a significant, we're behaving in a way that's quite different to any other parts of the country. And I see that coming through time and time again with some of the research I'm looking at. And you said that when you started, but in one area specifically that's concerning me is that area of labour, and what we can do. First of all, I'm not sure that people really understand how unemployment data is calculated. And I wondered if you could run us through that, because I think in our business community, we're going to have to try and establish our own labour reporting to really get the timeliness of the data we need and the localness of the data we need.
Yeah, I think that's a couple of really good points. I mean, people have been not watching data much for a while because everyone knew it was going to go down a lot. But now we're all starting to seek interesting, innovative data sources. The one I favour is we've got a lot of data on how people are using their electronic cards. So just today we had the electronic card transaction data from Stats New Zealand that aggregates the whole lot. I mean, gosh, that was negative 50% for the month of April. So that's a pretty incredible number. And
that's published publicly, isn't it?
Yeah, that's all public, and they've got a breakdown between industries, which might help you. The data regionally is not as good because it often relates to the head office of the firm. I get a look at anonymized data from within Westpac. Unfortunately, we can't publish that. Privacy is really important to banks. But I get a wee squiz at it, and we break out hospitality and tourism, for example, which Stats New Zealand doesn't do. And needless to say, they've been hit much harder than the wider economy. So I'm finding that useful to look at. I think the negative 50%, by the way, it's roughly in line with the sort of thing we were expecting. My overall take that about a 17% drop in economic activity in the first half of the year is about right. Because you've got to remember the tree's growing and the lamb's putting on weight. That's all part of GDP. Another interesting data source, just getting onto your labour point, is... And
just before you go on with credit card, does that include international transactions as well as national?
You can separate them out.
Okay, yeah, so our members could use that.
Paymark data, yes. Yeah. So Paymark, which is a conglomerate of all of the banks, has that data, and Stats New Zealand sort of uses the Paymark data and breaks it down and makes it completely public. So that's your best source of information, I think. On unemployment, actually, the number of people who've gone onto the job seeker benefit is not enough to really meet my 9.5% unemployment forecast. So I think that forecast is kind of in a little bit of trouble. I mean, we're still looking at it. You don't change your forecast that easily. I've got to get my unemployment specialist to really look at it a bit closer. But I'm starting to think that it's actually could be even less of an increase in unemployment than that, which, if that's right, it'll be a great outcome for New Zealand. What it might be is firms have held on to their labour through till the end of the wage subsidy, and then the September quarter, you'll see a bigger lift.
So when are those reports come out from unemployment data?
Weekly from the Treasury. So if you go onto the New Zealand Treasury website, they've got that's the best source, actually. New Zealand Treasury website, they've got a weekly data report. They were desperately searching for as much data as they could get. It's all nationwide.
And so that's not regional either, is it, though?
No, you won't get regional.
And so again, and so just in terms of that, the job seeker data, though, is only for people who are eligible for that allowance, which for, unfortunately, a lot of our unemployed here, they won't be.
I can see Benji, who's an economist that lives locally with you guys, is talking about MSD having local data. So I think
I've got that. Okay,
yeah,
cool.
Benji would be really good with finding you local data.
Please be in touch.
What's that?
I was going to say, please be in touch.
I do think, just to make a comment on the unemployment data, yeah, I think it's going to completely belie the employment situation. A lot of people will become non-participants. So they'll just go back to study. They were over 65. I've got a friend who's 68 or so, and he's a bus driver and for the cruise ships, and he doesn't bother when he's been laid off. He's not going to become unemployed. He just drifts away. A lot of people will actually become non-participants. The other source of information will be the quarterly employment survey, which tells us what the change, that actually surveys employers and tells us how many fewer people they're employing. And I think that will probably be more interesting. In Queenstown, I think you'll just have when's the last time a Kiwi served me a coffee or a milkshake in Queenstown? I don't hear too many Kiwi accents down there sometimes. It's how it feels. So those people will just disappear. I presume that they're already gone. So the number employed.
No, there's 3,438 of them here still. I get the numbers weekly.
Is that right? Sort of hanging around with that.
That's just the essential skills, and then another 3,500 working holiday people, plus families. So we've probably got 7,000 to 9,000 of them here.
Put it this way, if a working holiday person is laid off and unemployment is so bad that they can't find another job, they're not going to enter the ranks of New Zealand unemployed. They're either going to go do something else, spend the last of their money and tour around while they can, and then go home, basically. So employment could drop a long way without unemployment becoming a big thing, both nationwide and in Queenstown.
Okie dokie, thank you for that. I've got some questions here. So here's one which I think I'm going to read to you as it is. Do you not think there was an economic negative trend which has been forwarded by COVID-19? That is to say, the economy was already heading into a recession, depression, housing bubble, debt bubble. If at all, how long do you think it will take for inflation to kick in with all the liquidity being pumped into the real economy? And which goods and which product services will the inflation hit first, and which will be deflationary?
Okay, there's a lot in that. I don't think we were. I don't know. My forecasts were, we certainly had a slowdown during 2019. That was very clear. All the evidence very clearly showed that we were coming out of that. So a lot of people extrapolated from that. I actually stood out and said, no, hang on. I think what's going to happen is the Reserve Bank's going to cut interest rates a lot. That's going to generate lots of momentum in the housing market. That will do what it always does, which is generate consumer spending, a burst of consumer spending, and that will tend to drag the economy higher. Now, your concerns about debt going to get even worse through that process. But the thing is, that's what happens when interest rates drop. You tend to permanently take on more debt, and you create a period of stronger growth. And we were actually going into that process. No, I don't think we were sort of on the way down. Of course, all of that's irrelevant now. I feel like I had a huge sort of debate about that last year and felt like I'd gotten it right, and it's completely irrelevant now. It really doesn't matter. Your question about inflation is an interesting one. Near term, when the economy goes into a big downturn like this, you get low inflation. That's just, you get an output gap. You will get low inflation due to low demand. I mean, just have a look at what's happened to the price of oil, because it's still coming out of the ground and no one's using it. And that will apply to many, but not all markets. And so you tend to see a real lack of inflation over the next year or two, I think. That'll show up a lot in construction. That tends to be an area with quite variable prices. Builders will have to sort of peel back their ability to sort of price higher will be diminished. And probably least in sort of consumer goods that come from overseas. After all, we've had a drop in the exchange rate, which will push those things higher. Wage growth, I think, will be minimal for a couple of years. With, again, 9 or 10% unemployment, you're not going to get much wage growth other than mandated minimum wage increases. However, I do think you raise a good question. How long does the low inflation last for? Because I think it's really critical to understand how long can the Reserve Bank continue to bail out the government and actually bail out private sector borrowers and dishing up these really low interest rates or buying the government's debt off it to dish up low, easy to maintain your debt kind of, how long can that carry on? And the tone of your question, you're sort of worried about rising debt. That's kind of, at what point does that rising debt become an issue? The exact point is when interest rates start to rise, actually. It's not an issue until then. And interest rates start to rise when inflation rears its ugly head. Now, after the global financial crisis, we had year after year after year of ongoing really low inflation, basically because global supply chains were improving, global productivity was improving due to new technologies, allowing firms to deliver goods and services to consumers more cheaply than they could in the past. That kept inflation low. It meant central banks could keep interest rates low, and it meant people could continue to borrow and live with all this debt and continue to run with this an improving economy. I actually think this time, what generally happens after recessions is you get those low interest rates, you get a recovery, inflation starts to emerge, and then the central bank has to remove its monetary stimulus by lifting interest rates again. And that process had actually started in the US. I think that process will be faster after this recession, because I think global supply chains are going to be disrupted by COVID-19. And that could actually generate its own inflation. If I'm right about this, is not something that's going to happen soon, it's a few years away, but if I'm right about that, it might mean that monetary stimulus needs to be withdrawn earlier in the cycle than it was after the GFC. And then you might get your problems with higher debt or ability of government to continue borrowing. So that's a story for the early to mid 2020s, monetary stimulus being removed earlier than after past recessions, but it's absolutely not a story for the next year or two, which is low inflation, low interest rates for the next couple of years. I can't hear you.
Do you know what percentage of GDP comes from international tourism?
I know that closing the borders but is basically worth around just over 3% of GDP.
Okay, sorry. Tell me how you feel the government's going to stimulate. What do you got any picks on where that infrastructure spend is going to go, or Kiwi Build? And
it won't be called Kiwi Build, that's for sure. It'll be anything but Kiwi Build. But yeah, there's been a hint that I think if they're smart, like my recommendation to government and to firms is to prepare for a more digital economy, because I think that's the big change that COVID-19 is going to create. So, creating infrastructure in that direction is what I would recommend. What I think that might happen, if I'm lucky, what will happen is basically anything that they can do, they'll do. So I know that I'm on the board of a school actually that's had a project sitting there for more than a decade, and it's more than shovel ready. It just needs the funding. So that's the sort of thing that'll get the tick. It's just projects that were already in train will just get a big tick because they're desperate to get money out the door. And frankly, I talk to them often. They're sort of scrambling to put together decent proposals and to get money out the door in a decent way. So they'll do whatever they can do is probably the key. There's been talk of money dished up to every household. I don't think that'll happen. I think it'll be more targeted. So there could well just be a cash payment to all beneficiary households or something like that. There's somebody not on mute.
it might be me.
Sorry. Yeah, so those are the two key picks. And the other one, I mean, Robertson's talked about a strong public service. So, I mean, I think the health system, we had a bit of a scare there. But he wants to build the public service because, as I say, they've been scrambling to find the ability just to administer all of this money going out the door, and they need to build that up further.
Okay, I have been concerned a little bit about the lolly scramble approach to this spending, and I see it was touched on this morning on the news about the non-targeted nature of some of the support that's been going into the market, and I'm just wondering it concerns me, because it seems like some of those normal policies, procedures we might go through in terms of making sure that that spend is efficacious and going to do what it needs to do. Expediency means we've pushed that out the window. Do you think that's a concern?
Yeah, I share your concern. I think probity is going out the window. People with a barrow to push are going to push it now. I've had all sorts of discussions with all sorts of people who kind of keep saying, well-meaning, who, maybe their particular issue that they're worried about is housing, and they're saying, right now we can fix the housing problem. And it's not like the housing problem's changed because of COVID-19 at all. If you were going to fix it, you should have fixed it before. That's not, it's a great thing to do, but I don't understand why there's a greater reason to do it now. So people are going to scrap over the money. There's an awful lot of it. There's democratic consent for the government to spend whatever it wants. I actually think it does need fiscal stimulus is required, so there is a strong reason for it. I hope it's as well administered as it can be, but look, it won't be as well administered as during a normal year. I think that's just the
reality of the situation. Craig Smith said, fiat-backed digital or gold-backed digital? I don't even understand what that question, does that mean anything to you?
Fiat.
Fiat, there you go. Craig, I asked the question, you'll have to tell me what it means later. Do you want to expand on what that means?
There are people who are sort of concerned about money that's not backed by anything. They think it should be backed by gold. I'm not one of those people. So I think it's a question about whether we should go back to a gold standard, basically. And my answer is no.
Someone's asked quite a question that's, I don't think that possibly you'll want to answer, but it's a question that's really very much on business owners' minds here. What percentage reduction in sales should we conservatively budget for bank budgeting purpose this financial year? Obviously, that depends on the industry you're in. Let's assume it's hospitality and tourism.
Sorry, I can't answer that question. It's up to your business, and I think the economy will be about 6% smaller at the end of the year than it was at the start. But your business could be bigger if it was Zoom's a lot bigger than it was, or it could be a lot smaller. Yeah, it depends on your own business. So I can't really answer that. Oh, you're on mute again, Anna.
Sorry, I've got an annoyance in the room next door here and the home work environment. So could you talk to us a bit about these government loans? What's your thinking on those? My view is that they haven't really been that successful. Certainly not now our neck of the woods.
No, they haven't been. I think what's happened is banks have been extending quite a bit of credit to their customers, and so the government loans. It's a 3-year loan. If the person who takes the loan defaults, the government will wear 80% of the cost of that. And the Reserve Bank's provided the funding. So basically, it's government trying to co-opt the banking system into providing its credit services to determine who can get a loan and who can't. The thing is, the terms of the loan are probably stricter than what a bank would normally provide to its customers. I don't think people have been sort of desperate enough to want to take it because they've had the wage subsidy. It could well kick in as people get more desperate after the wage subsidy has passed and need it. But so far, it hasn't really had any effect.
Do you get a sense, Dominic, that the government has left tourism a bit out to dry on this, or is going to use this to drive some of the corrections it wanted to see in tourism?
Which corrections are they?
Well, I think they were concerned about tourism numbers and it being a low value, or what they considered a low value industry or sector, that it wasn't a sector that they wanted to see grow in terms of the economic weighting within our economy.
Oh, I think there's
you
lots
don't get that sense?
Not really. There's a lot of
Good.
businesses that feel under pressure from the government because they worked harder than the previous government to try to ensure that the social and environmental impacts of business were
Mitigated.
acceptable.
Mm.
So farmers feel under attack. They're not under attack. They just have to pay for their emissions now. Tourism felt under attack. I don't think they're under attack. It's just that people don't want poo in their rest stops, you know.
Mm.
And perhaps the Labor government was doing more to prevent poo ending up in the rest stops than a national government was.
Mm.
No, I actually think they'll be desperate just to get anything they can. No, I don't think they're going to. I think, if anything, they'll loosen up. They will try to create whatever, beggars can't be choosers kind of thing.
Mm.
They'll be under lots of pressure from an industry which is now more or less absent. Lots of people who previously relied on that industry, they'll be under pressure to get whatever they can in that industry. And it'll be a beggars can't be choosers type situation. That's my pick. It's up to how the government behaves.
Yeah, exactly. Okay, well, I think that's taken up this hour. Thank you so much for your time today. And I found that really useful. Certainly, I did use the opportunity to shamelessly pick your knowledge about that data issues. So I'm very grateful for that. But we are such an outlier in terms of our response here and the impact on our community. We are going to have to really try and understand that to help us guide our thinking in the next recovery period, next couple of years.
Okay.
So I really appreciate your time. Thank you very much on behalf of the Queenstown Chamber, on behalf of the members who came today. And and thanks again to Westpac for your continued support of us.
No problem at all. Thank you very much, and thanks for the questions. Cheers.
Okay. See ya. Bye.
Bye.
Bye.